Hey everybody, what's going on? It is James. It's a little after 5 a.m. and I know I just released a video a few hours ago, but I wanted to do another one because I'm going a little stir crazy right now, and I thought, man, I've got nothing to really do that I feel like doing right now. I have stuff I could be doing, but I don't feel like messing with it right this second. So I figured I'd sit down and shoot this video, and I'd talk a little bit about the market, where the market's at, and also talk about what I think is coming based off of the charts themselves. So before I jump into the content, let's do a few things. First off, please remember, I'm some guy. I'm sitting in a spare bedroom. It's 5 a.m., so this is a bit of a brain dump. Nothing in the video is financial advice. You should always go out and do your own due diligence and seek out professional financial advice from a licensed financial advisor before making any type of investment in cryptocurrency, the stock market, precious metals, Forex, or any other tradable asset. Also, right now, stop what you're doing, hit the thumbs up button, subscribe to the channel, and click that bell icon to get notifications when I release new updates. This is the NASDAQ chart. This is a monthly chart. This goes back to the mid-80s. And of course, this is the dot-com bubble. Then it fell. This is the current bubble. And of course, this is our move down so far. So there's general rules and technical analysis that we can follow. These rules work in every market. They're not based on emotion. Well, I mean, they are because they're based on the emotion of the market. But they don't change based on, what you think is going to happen. They're set in stone the way these rules work. So we're going to talk about some of those rules in this video. One of those rules or general guidelines is that when you have a parabola, right, which is like this big sharp move up, you will typically get a blow-off move, a blow-off top, where things, double in a very short amount of time. For example, from, almost 7,000 up to 17,000, more than doubled, right? That's indicative of a blow-off top. And then you will get a 80% retracement. An 80% retracement it means that the market's going to take back 80% of that move, okay? So what you do is you draw a Fibonacci level from the bottom of your move, which in this case will be back in March of 2009, to the top of your move, which in this case is November 2021. And this 80% level, that's an 80% retracement. It means it takes back 80% of the move. Oftentimes, those retracements will look like this. They will have a leg down. They'll have some kind of leg up, right? Elliott wave traders will call this an A. They'll often call this a B. And then they have what's called a C leg, right? And that's usually where you start to range sideways and you get your market bottoms and things like that. This is basically about 13 years that we were in this single massive parabola where there weren't proper corrections and it was just parabolic. And if you're wondering why, well, emotions are a big part of it, but also this is when the Fed started going heavy with the quantitative easing types of programs, okay? So every time it would start to drop, the Fed would start printing more money. They would start injecting liquidity into the market. They'd start manipulating interest rates, all these things to keep the money flowing, basically. And that's why it did what it did. This is one of the things that you need to be aware of. We're in a quantitative tightening environment, and typically speaking, we're going to get about an 80% retracement now. So that's, just one thing to consider. Now that's going to, say that the market's going back down around this 41.85 level. And then you start looking for other reasons. You start asking, would that level make sense? Is this level hanging out in the middle of nowhere? Like, why would it stop there? Why not keep going? Or why not stop before there? And what else do you have at that level? Well, it's very cliche for a market, once it breaks all-time highs, to eventually retest those all-time highs. In this case, the highest monthly close ever was at 4,397. And so where is that? Right in the ballpark of that 80% level. Where else is that? It's right in the ballpark of this consolidation range, which is yet to be retested. Again, very cliche market behavior to come back and retest your breakout range, which is this range right here. Okay, all of those things make me think that this is a valid and viable target for the bottom of this current bear market. If we take a look and say, well, how far did the last bear market on the NASDAQ fall? Well, we know that it fell just over 83%. about 83.49%, almost identical to the drop in Bitcoin, back in 2018. If we had a move down to this 80% retracement, back down to this range, back down to this level, where would that put the drop? Well, it would put it at 75%, which would actually be less severe than the drop after the dot-com bubble. Not more severe, but less severe. And then if we add even more indicators looking for more congruence, we can do something like say, well, where did it bottom last time? Was there a moving average that it bottomed at? And yes, there actually was. The last bear market, and this is for a lot of the major indexes, the last bear market actually stopped right around the 200-month moving average. So if we put this moving average on there, you can see that, boom, that's right where the bear market bottomed in 02, which, by the way, is very similar to what happened with Bitcoin and its 200-week moving average in 2018, right? It retested that moving average here in 09 during the financial crisis, and then it went absolutely bonkers. Well, where is our 200-month moving average right now? It's sitting right around 4,984. We're above it, so it's going to keep curling up, remember, but it's down in this general area. And the scary thing is we've seen this in other markets. During deep bear markets, we often lose support of those major levels, actually retest them and consolidate underneath them. I'll show you an example of that in just a second. Here's one example right here, and this is a lot more extreme than it looks. Okay, this is actually a break. It fell about 25% underneath that moving average. So if it fell underneath this one by 25%, that'd be about right there. Okay, now again, it's going to curl up. So if it does what it did in 09, it's very similar to this level around 4,000, around the old all-time high, all those things. We will add a visible range volume profile, right? This basically measures, well, we can't add that because the index doesn't have any volume information. But we'll add it on the QQQ, which is an ETF for tech stocks. So if we add that on there, right, let's take it off log. Do you see the problem with this? We have a massive problem here. Our actual volume support, our point of control, which is this red line, is actually at $44. This is an ETF, right? So $44. Now this thing topped at over $400. So you're talking about to get back to the point of control would be a drop of 89%, and to get back to the top of the support block would be 87%. So suddenly this 75% drop to get back down to 108 seems far less absurd, doesn't it? And when you look at this, and I've talked about this in other videos, so some of you who watch all my videos, you're going to recognize that, this is not the first time I brought some of these concepts up. But the other thing is, let's take a look at a side-by-side between the QQQ, which again is an ETF for the NASDAQ, and we're going to take a look at it on a monthly chart. We're going to take a look at Bitcoin on a weekly chart. Do you see the similarities? Here's your dot-com bubble. Falls 83%. Bitcoin also falls 83%. You have your dead cat bounce. You have your bear trap, right? This is the 2009 housing crisis. This caused a bear trap on the NASDAQ. You have your bear trap, your quote-unquote COVID crash on Bitcoin, and then you have your parabola, your parabolic run. This whole run. The interesting thing is the QQQ and the NASDAQ had been leading Bitcoin. It actually had been showing what Bitcoin was likely to do. Again, if you put a 200-month moving average on the NASDAQ, you'll find that it bottomed there in 2002, and then again in 2009, right? Again, I've got to put the actual index in there so you can see it because QQQ doesn't go far enough back. See how it stopped right there and then stopped right there? Now watch what happens if I put a 200 moving average on the weekly chart of Bitcoin. And there you go. See how 2018 bottomed there, 2020 bottomed there. I mean, these are almost identical charts. That's the scary thing about it, the crazy thing about it. You see how Bitcoin has now lost that 200 moving average, and we are trying to break back through right now, right? But again, it went below it. So if the NASDAQ does this very same thing and goes below that by 20-25%, it's going to put this right back down at that 4,000 to 4,500 level on the NASDAQ, which is going to be a 75 to 80% drop, just like the dot-com bubble. And so I'm not telling you that to scare you. I'm simply saying, like, if you take all the emotion out of it, the problem is it's very hard for people to separate themselves from it, because either you have a bunch of money in the market already, and so you're just hoping and praying that I'm wrong so that it goes back up, or you don't have any money in the market and you're hoping and praying that I'm right so that you can buy, cheap stocks. And the thing is you got to forget all that stuff, because all that emotional baggage, it just clouds your judgment. That's all that stuff does. These are the things that I see, right? These are the things that are going on. And, same thing with Bitcoin. If we put a volume profile on there, which is easy to do, we'll just slap it on there real quick. We already know, anybody that watches this channel already knows, the point of control is way down around $12,000. Sorry, not point of control. The ledge of support is down around $12,000. Point of control is down around $1,500. And I hate to break it to everybody that is bullish and trying to pin their hopes and dreams on Bitcoin, but a regular bear market in Bitcoin is an 80 to 90% drop. That's what happens in regular bear markets. And that's during this. Bitcoin was born right around this area. So the whole time Bitcoin has been born, the stock market's done nothing but go straight up. And even during those beautiful conditions, Bitcoin had 80 to 85%, 90% corrections, or bear markets, whatever you want to call them. Well, this ledge is about an 83% drop. So if the stock market was really good, that ledge would make perfect sense, to stop there. But if the stock market really does go back to 2000 levels, that's going to take it back to 2015 levels. Wouldn't it make sense that Bitcoin would also go back to its 2015 levels? I mean, I'm not saying it goes back to $100. I'm just saying, think about that. There is a volume gap that sits right here between 3,000 and 6,000. Point of control is $1,545. Those are not emotional opinions. Those are our facts. So I'm not doing this video to scare you, because again, right now, if you watch my last video, which I hope you did, if you didn't, you should go watch it. It's a tutorial on trading option spreads. But in that video, I talked about the fact that I do think this market has overextended itself to the downside. And I had said this back on July 3rd that I was out of my bearish positions on Bitcoin. I actually expected a bounce. I suspect that it could very well move back to 28 or even 32,000 in that zone somewhere before we get more downside. I still think this bounce is very, very likely to happen. We've already moved up about 20 to 25% off of the bottom. This is Bitcoin versus QQQ. This would take it right back up to retest this range back here. It would be very, very cliche market behavior to do that. And then have your final move down where you fall back into this, old disbelief box, whatever you want to call it. And this would be the area right through here. This right here would be your anger. And then you would have your bottoming phase where you finally reach depression, where people just give up on it altogether. You have to think that in the last bear market in Bitcoin, it took 12 months to the bottom, 12 long months, and it basically capitulated in November, and then it really didn't get any kind of momentum until April. 5 months later, it finally started to move back up. 5 months. We have not had 5 months of consolidation anywhere during this move. If you look at the stock market and past stock cycles, the dot-com cycle, that didn't happen quickly. From the peak was March of 2000. The complacency bounce happened in September of 2000, which was 6 months later. And then when it finally bottomed, it was in October of 2002. It was 2.5 years that market cycle took to play out. 2.5 years. 31 monthly candlesticks. So if we repeat that type of timeline, you're talking about a market bottom sometime in the summer of 2024, 2 years from now. I think that's very likely going to be the scenario that we face. And then if you really want to get down to it, and people are not going to want to hear this, but I'm sorry, this is reality. It wasn't like Bitcoin cycles where you bottomed and then went straight up, for 1,000% returns. when the stock market bottomed in 2002, it ranged sideways for a decade. We did not take out the 2000 all-time high until, ready for it? Right around 2016. It took 16 years to take out that high. So my question to you, especially if you're somebody who doesn't know how to trade and you're just gambling and you're just hoping and praying that you catch a bottom, are you willing to hold your assets for 16 years to see a return? I'm not saying it will take 16 years. I'm saying historically that was the case last time that we had a tech bubble pop. 16 years. When we had the housing bubble pop, people talk about this. This video turned into a long video. They always do. The housing bubble popped, right, in the latter part of 2007. And people say, yeah, and it bottomed in 2008, 2009, whatever. And the stock market it did, but housing prices actually continued to fall until almost 2012. It actually took about 4 years, a little over 4 years, for the housing market to start to recover. Well, guess what's happening right now? We are literally seeing a housing bubble start to unfold, right? You can go out and look up all the data you want on this. You'll find all kinds of articles talking about how mortgage demand is, at an all-time low for like the last 20 years. You'll start seeing default rates are going up again. You'll start seeing things like the auto industry, repos are skyrocketing because people went out and bought these cars that were $800 and $1,000 and $1,200 a month car payments, just absolutely insane. And all of this stuff is going to be hitting at the same time. I suspect that it could very well be worse than the last financial crisis, but I don't want to be all doom and gloom. I just want to say that use your head and think about this, because most people make irrational decisions because they're afraid of missing out, because they think they're going to miss the bottom and it's going to go straight back up. And, we're going to see the NASDAQ suddenly at, 30,000 points, and we're going to see Bitcoin at $150,000. And it's very unlikely going to be the case. It's very, very likely that this will do what it's always done and have a prolonged bear market that lasts a couple of years, and that it will then range for 10 or 15 years before the next boom cycle starts. Because that's how markets work. They're bust and boom cycles. Fear and greed cycles, whatever you want to call them. This is the Dow Jones Industrial Average. And to give you an idea of this, right, when this bubble popped in 2000, again, you can see it. It basically ranged sideways, just sideways. Yes, it did put in a new high here, but it wasn't explosive. It wasn't like this, right? It's basically just a big range that started to expand. And you go back in time on the Dow Jones, this was the 1929, the Great Depression. Most people have heard of this. Even if you live in the U.S., this was a big deal. So it started falling in September of 1929. It bottomed in August of 1932, almost 3 years, right? And then how long did it take to break that all-time high? Ready? So again, bubble popped in 1929. It broke the all-time high in 1954. It took 25 years to break even if you bought the all-time high. Markets, this parabolic bubble we're in, unfortunately, they're kind of once every 30, 40 year type of events. We actually got kind of lucky in some senses. I mean, not really lucky because it kind of sucks for us, but we kind of got lucky in some senses that we had 2 of them in 20 years. So our, maybe not so much my generation or younger generations, but maybe the people who were just a little bit older than me, who may have taken retirements that were at 500,000 a few years ago, and maybe they cashed them out for 2 or 3 million. Those people, I don't want to call them lucky because there's other things that they're going to have to face. But I'm just saying, like, these parabolic markets, that those are not normal. See how it just ranged sideways for like 20 years, right? So it took 25 years to break that, then hit an all-time high again in 1966, and then ranged sideways until 1982, 16 years, right? Hit this all-time high and then basically ranged sideways for, over a decade on the Dow. And I'm not saying that these are guaranteed to happen. I'm not saying that, I can't even tell you for sure that this is a bubble. I can't even tell you for sure that this is a bubble, and this is not just a correction that's going to end up going higher. But if it is a bubble, which I believe it is, history has said that these things take decades to clean up. not months. So really long video. If you made it all the way through it, I commend you. You have a better attention span than I do. I have a really difficult time watching long videos, so I appreciate you. Please remember that obviously, like I said at the beginning of the video, I am just some guy sitting in a spare bedroom. Make sure you're doing your own due diligence. Make sure you're seeking out professional financial advice from a licensed financial advisor for making any type of investment decisions, whether that's on crypto, whether that's on stocks, whether it's on Forex. It doesn't matter what you're investing in. You really should seek out some professional advice if you're not a professional yourself. And yeah, other than that, make sure to give the video a thumbs up. Make sure to subscribe to the channel. Go ahead and click that bell icon to get notifications when I release new updates. And most importantly, remember that your job as a trader is to make sure that you survive to trade again tomorrow. So always use proper risk management and never put yourself in a position where if you're wrong, you can't come back from that. All right, this is James. I'll talk to you in the next video.